It would help if you learned a lot about working in the corporate sector. You still have a ways to go if you believe you already know everything. So allow me to advise you and define a few new key phrases in the business world. I hope you may learn some terms at the end of this video that you can use in your business. We'll explain something today that we haven't covered before, but that I believe is significant. Defining fundamental financial concepts is essential for generally feeling at ease with money. You should feel comfortable utilizing both corporate finance and investing, and understand their significance when they are brought up in discussion. Therefore, today's discussion will cover 9 different concepts, beginning with the first one, which is capital. The term capital, which you may have heard of before, is also something you would associate with money. In contrast to a firm's money, capital indeed refers to all the resources a corporation has. It has anything that can add to its entire worth into how much it can do, and obviously when a company expands. Now that could be human resources, that could be financial, and that could be other things. It may occasionally need to invest more money to support that expansion, whether through hiring a lot more staff or buying a firm like WhatsApp when Facebook did. Usually, this money will come from the company's financial reserves. However, there are instances when a firm needs to turn outside of itself for that investment in the form of debt or stock. Which brings us to number 2, debt. You've undoubtedly heard of debt and may well be a victim. Therefore, you likely already know to some degree that debt refers to a loan that must be repaid, typically with interest. Bank loans and bonds are examples of debt. Each has unique characteristics, such as the order in which they must be repaid or the seniority of the lender's rights over the borrower's assets, commonly known as security, which legal protections are provided for lenders and whether the interest is constant or fluctuating. Now, similar to when you apply a loan on your own in private, as in the case of consumer credit, the loan's terms and how interesting they are for all parties will mostly depend on 2 factors: the borrower's creditworthiness and the state of the market. The reassurance that lenders will be paid back before shareholders is now a part of debt security. For instance, if the business ever files for bankruptcy and has to make payments to everyone, in that sense, debt securities are typically less risky than equities. Lenders usually receive a smaller but more reliable return in exchange for this preferential treatment and the fact that everything usually is less complicated. Retail investors, a fancy name for folks like you and me who might be investing, have the option of investing in individual loans. Many investors opt to use index funds, mutual funds, or ETFs, which spread out your money by placing it in a diversified basket of bonds and loans. Number 3, equity. On the other hand, equity is distinct and denotes a stake or portion in a corporation. When everyone has been compensated, you have that right. If we remember correctly, the lenders are paid before the shareholders when all debts have been settled. Now this is somewhat akin to the exciting, hazardous, and fun type of investing we see on programs like Shark Tank, which I personally adore. And it certainly has that allure because your investment can grow very quickly or extremely large if the company works well. It also carries a lot more risk, because if the firm does poorly, it goes without saying that those shares will be valued for much less, or the worst situation, be utterly worthless if the company must file for bankruptcy. Therefore, if you're comparing the two, that is essentially a slow and steady process where we give you money and you always pay it back. What occurs is more like a beautiful roller coaster because you have to and equity. Depending on how the business works, this may go incredibly well or poorly, which still feels fantastic, which leads us to the next point, number 4, primary issuance. Primary issuance refers to a firm's direct sale of stock to investors. This can be done through an IPO, a subsequent equity sale, or even by going straight to banks and investors in the stock market. Because everyone is actively trying to determine the value of everything, primary markets now tend to be more volatile than secondary markets. Which brings us to number 5, secondary trading. Nowadays, secondary trading happens when individuals buy and sell their shares to the market over the counter via a broker trader. Nowadays, most investments are made between investors rather than through the means of the business, and it's crucial to keep in mind that when people purchase and sell stocks, it's not usually because they need to sell all of their shares to someone else and cash out. After all, the stock is performing poorly. It could be for various reasons, such as the owner of the supplies needing money at the time or changing up the portfolio, to name just the 2. The owner of the stores may have needed cash at the time or was reorganizing their stock holdings. There could be a variety of causes, but the stock market isn't necessarily dependent on things that aren't performing well. That's how we're going to exchange goods. In fact, it's considered a good thing that there's all sorts of liquidity and motion going on. If someone tries to sell, there will likely be a buyer, so you know the market is within a reasonable range. Additionally, it promotes the auction process, keeping the share prices where they should be. Number 6, we're going to touch up on mutual funds. A mutual fund is one of those concepts that most of us have certainly heard of and evokes thoughts of elderly, wealthy individuals. A mutual fund is an investment vehicle run by a qualified money manager whose responsibility it is to put that money to work, investing depending on the objectives and tactics of the fund into a diverse portfolio. Mutual funds now allow investors to invest in diversified portfolios that would otherwise be challenging with a small amount of capital and will enable you to gain more expert advice. There are currently a lot of discussions on which investments produce results more effectively, passive or active. However, some convincing proof suggests that a few mutual funds have made fantastic returns over the past 10 years, and in the description, we'll include the link to that so you can learn more about it. Number 7. Exchange Traded Funds or ETFs. It's an investment that often tracks the value of a particular commodity, a bond index, or a stock market index. Investors can now purchase and sell ETFs the same way they would to a stock. Ordinary stocks, the high daily liquidity, and the inexpensive cost of ETFs have led to their enormous popularity. Number 8. Volatility. Volatility gauges how much a stock's or other securities' value has changed over time. This one is pretty self-explanatory, and that something with a high level of volatility is typically harder to predict in the future and is therefore viewed as a riskier alternative. But as we all know, investing is about balancing risk and return. You maximize your return while minimizing your risk. While a more volatile option is undoubtedly more complicated, it provides the allure of potentially more significant gains and losses. Furthermore, investments with more excellent stability and less volatility are more likely to yield moderate returns. And as the investor, it's up to you to assess your level of risk aversion. Do you want to go with something that will be somewhat slow, steady, and modest? Or do you want to take the chance for a payout that could be greater? It may appear to be incredibly tough to gauge your unique risk tolerance. However, a few elements are pretty standard, such as your timetable, ambitions, and your present financial status. How much danger can you take in all honesty? Finally, number 9, we have diversifying. We are introduced to diversification, which is the word that even though we may occasionally use, no one really understands the meaning of. In addition, diversification refers to avoiding placing your eggs in one basket. But it's a bit more complicated than that regarding the actual plan and thought that goes into it. It's vital to consider whether the stocks or assets you're buying to move in synchrony with one another, meaning that if one thing goes wrong, the others will likely follow. Everything's going to go wrong that way. As a result, diversification is sought for when investors want to lower the volatility of their portfolio. They want to invest in things that don't wholly correlate with one another, because those investments will be slightly less hazardous overall, because certain things could change and go down while other unrelated things could change and go up. Of course, this does not imply that a diversified portfolio will never experience a loss or have poor performance. It's about minimizing the money that you lose. At the very least, there will always be periods when the market is down, and consequently so is your portfolio. But diversification, however, truly helps with unsustainable ones. Now, investment is a talent that we all have to master throughout our lives at our speed, but simply understanding what these terms represent is one of the critical components of developing confidence in handling your own money and generally entering the realm of investing. And rather than just being afraid of these terms and avoiding them altogether, we highly advise visiting websites like Investopedia, which will contain a link that provides a definition of each financial concept. Anyone can be an investor, including and possibly especially you, so use every single piece of knowledge to your advantage. And that's it for today. Thank you for watching this video, and if it helped you in some form, please do like, share, and subscribe. We'll see you in the next one.